Pepsi stock is currently trading at nearly $172 per share, and it's only down 0.62% year to date, despite the market being down pretty large during that same amount of time. And in the past year, we can see they're up nearly 20%, so really good returns over the past year. Now, I think there's two different reasons that this stock is currently being talked about a pretty fair amount. The first being, this is considered a low volatility stock, so we're talking about a time when the market could potentially decline, and because of that, investors are really looking to invest into low volatility stocks. The other reason behind this is PepsiCo is actually getting ready to become a dividend king. They've been increasing their dividend for 49 consecutive years, so that provides a lot of safety for investors. But in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find exactly what the intrinsic value of Pepsi is. And on this spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. So let's go ahead and jump over to our stock screener. And if you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. We're going to come up here and we're going to plug in Pepsi stock ticker and hit enter. And we're currently looking at a 500-day chart. You can see we've seen a pretty nice run up over the past few weeks. And if you come over here, the first thing you'll notice is the dividend yield is currently sitting at 2.5%. Not a super high dividend yield, but the dividend growth has been really good lately. Let's go ahead and jump over to Graham's valuation, and we'll zoom in just a little bit here. And Graham's valuation was a valuation model invented by Benjamin Graham, the author of The Intelligent Investor and one of Warren Buffett's mentors. And you can see the formula he laid out for us here. So essentially what we're going to do is we're going to take the earnings per share and multiply that by 7, which is the price to earnings of a company with no growth. And that 7 is going to be added with an 8, which is a growth rate projection for the company. We're then going to multiply that by 4.4, which is the average yield of AAA corporate bonds. Once we've multiplied all this together on the top, we're going to divide it by Y, which is the current yield on AAA corporate bonds, which at the time of this video is 3.33. And based off of this, we come to an intrinsic value of $111 per share. But let's go ahead and jump forward to our discounted cash flow model. And in order to perform our discounted cash flow model, we need to project a growth rate for the future free cash flows for this company. So in order to do so, I looked at the historical free cash flow data for Pepsi, and we could see over the past few years, they've had an average growth rate of about 5.18%. I do think it'll be just a little bit higher than that typically, so I'm projecting a growth rate of about 7.5%. So not a super high growth rate because this is an older company, but I think 7.5% should still be attainable for them. So I applied that growth rate for all the future free cash flows for this company and also calculated the terminal value, which is the sum of all the free cash flows past the year 2030. I then took the present value of all of these future free cash flows and added them together, which we can see right here. I then added the company's cash and cash equivalents and subtracted out their total debt, which allowed me to find their equity value. After getting the equity value, I then divided that by the number of shares outstanding for this company, which allowed me to find a discounted cash flow price per share of $106. Now let's go ahead and look at our multiples valuation model. And essentially the idea behind our multiples valuation model is we can look at how the market is valuing companies that are very similar to Pepsi and use a price to earnings multiple and apply it to Pepsi to find their intrinsic value. So let me explain that a little bit more clearly. So essentially what we're doing is we're taking companies like Coca-Cola and Monster that are similar to Pepsi, we're taking their stock price and dividing it by their earnings per share to find what their price to earnings multiple is. I then used the average price to earnings multiple for this company and I multiplied it by the earnings per share for Pepsi. And we can see after doing so, it allowed me to find an intrinsic value of $171 per share. Now let's go ahead and jump over to our dividend discount model. And essentially the idea behind our dividend discount model is we should be able to value a company based on how much they increase their dividends and how much they're paying out in dividends. So I looked at the historical dividend payouts for this company and found their yearly dividend payouts. This allowed me to see what the growth rate was for the company over the past few years when it applies to their dividends. And we can see their dividends had an average growth rate of about 7.6%. So that's a pretty good average growth rate for their dividends. I don't know if it'll be that high forever, so I applied a growth rate of about 5.2%. After applying a discount rate of about 8%, we can see the dividend discount model led us to an intrinsic value of $161 per share. Now let's go ahead and go to our output tab. And here in our output tab, we can see all 4 valuation models: Graham's valuation 111, multiples valuation 171, discounted cash flow 106, and our dividend discount model 161. When we average all these together, we can see our intrinsic value is $137 per share for this company. The company is currently trading at $171 per share, so obviously, once we apply a margin of safety, even if it's a small one at 10%, our stock valuation spreadsheet is going to tell us this is not a company that we should be buying. Now, I'm not surprised the company is priced currently over its intrinsic value. I think investors are going to this company for the 2 reasons I mentioned earlier. It is a low volatility stock, and also they love the dividend growth they've seen from this company. But for me personally, I think there's probably going to be better opportunities in the market for dividends, dividend growths, and price appreciation as well. So this is not currently a company on my watch list. But go ahead and let me know in the comments below what your thoughts on this company are and if you plan on buying any in the near future. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.